It's time for the Money Puzzle Podcast. With good conversations and realistic solutions to the money puzzles we all face every day. I'm your host, financial advisor, chartered financial consultant, and president of Edgen Insurance and Financial, Robert Edgen. Now let's get this show started. Hello and welcome to the Money Puzzle Podcast. I am Robert Edgen and I'll be your guide for the ride for the next few minutes. This is the place where we have candid conversations about money, finance, investing, and all of the other pieces of the money puzzle that you need to figure out so you can have the financial confidence you deserve and the future that you dream of. We are currently in the midst of a full-blown coronavirus pandemic craziness that has swept the nation and the world. So you may be wondering, can I be financially confident? Will I ever have that future that I dream of? You know, the markets are currently down about 38%. I can't eat out. I can't go out. I can't find any toilet paper. How will I ever be able to have that future that I dream of? If that's the way you're feeling and thinking, I get it. As a small business owner of more than 25 years, I can tell you that I have personally never seen anything like this. As a financial advisor and planner, I can tell you that none of us in the industry have seen anything like this, but we have seen things that resemble this. Things like SARS and Zika and the swine flu. We've been through the Great Recession, but this feels different. The COVID-19 pandemic fear came from nowhere and captured and is capturing more attention and striking more fear in our government and the American citizens than any of us ever expected. And it is creating a lot of unknowns and uncertainty. And the stock market does not like uncertainty. Uncertainty creates volatility. Fear creates volatility. And like we talked about just a few shows ago, the media also creates volatility. The news or the noise creates volatility. But I am here to tell you that you will be okay financially if you keep a cool head about you, if you know your goals, if you stick with your plan, and if you know how to handle your investments when crazy things like the coronavirus show up and threaten your portfolio. So that's exactly what we're talking about today. 4 different options for handling a major market correction. What are they and which one is best for you? I'm looking forward to getting into that conversation, but before we do, we get questions from people about their own personal money puzzle that we like to get answered. So let's take a minute and look in the Money Puzzle mailbag.
Mailbag.
Today's question comes to us from Andrew, who asks, I know the deadline is soon to get my IRA done. What is the deadline, and can I wait until the very last second? Well, I like the way that you're planning on waiting till the last second, Andrew, because honestly, as long as you get it done in time, it doesn't matter if it's as late as possible. The question here, Andrew, is when is that deadline and how long can you wait? And it's actually a really great question because as of just a few days ago for 2020 only, the tax filing deadline has been extended from April 15th to July 15th. That also means that your IRA deadline for 2019 has been extended to July 15th of 2020. So you have 6 months after the new year to make your 2019 IRA contribution. And this is awesome because you don't want to miss out on a year of investing in your IRA and getting that tax-deferred growth and letting that be there and ready for you for the future. So it's a great question. It's a great idea to do it. So make sure that you get it done before July 15th of 2020 and make sure that you specify that it's your 2019 IRA contribution. That was a great question, Andrew. Thank you for sending it over. We've got some cool new Money Puzzle Master t-shirts in the works, and I'll be sending one out to you for sending in your question. All right, that's it for the listener mailbag. Let's go ahead and get into today's hot topic. So we're in the middle of the coronavirus, and other than not being able to buy toilet paper, The crashing volatile stock market seems to be the other big fallout from the coronavirus. Stock markets don't like uncertainty. Uncertainty causes volatility, and volatility causes high sell-offs in all of the financial markets. The S&P 500, the Dow, the NASDAQ, all of those indexes that you follow that we refer to as the stock market. How you handle these volatile times will determine how you and your portfolio come out on the other side. And yes, we will come out of this on the other side. Will you have lost a bunch of money and need to recover? Or will you have pulled all of your money out at the wrong time? Will you be okay financially? That's the real question that our clients care about. What's going to happen with my portfolio, and will I be okay financially? Now, there's really only 4 options or combinations thereof when it comes to dealing with a big sell-off in the stock markets. You can either sell out, phase out, ride it out, or buy in. Those are the 4. Now, the right option for you depends on your goals, your tolerance for risk, how long you have before you need to spend the money, and what you need your investments and the money to do for you. In general, the shorter amount of time that you have before needing to cash in your investments, the safer or more conservative you need to be. Also, if your investments are there to provide income now, you're actually spending money from your investments, you need to be safer as well. But conversely, if you've got years to go before using the money and you're currently just saving for retirement, your goals and your time frame might be years down the road. That might allow you to think about risk a little bit differently and react a little bit differently to the falling stock markets. If you're in this situation, this might actually be an opportunity for you to get ahead. So let's look at all 4 of the options and talk about which one is best for you, starting with number 1, selling out. Now, you don't actually lock in your losses until you sell. Until then, your losses are all only on paper, and your portfolio has a chance to recover when the stock markets change. However, sometimes your best bet is to sell out and retreat to safety, even if it's just for a short time. If you're already retired or you're very close to retiring, your portfolio should already be adjusted so that a big portion of it is in safer style investments, often referred to as fixed income investments. Fixed income investments typically carry less risk because they pay investors a fixed interest payment or a set amount for a fixed period of time. So you can see why they're called fixed income investments. If you are retired or close to retiring, you should already have a certain amount of your money sitting in cash as well. That is going to be used for your actual income payments, the money that you're going to take out of your retirement portfolio. However, if you've not yet adjusted your investments for retirement, you might want to look at selling out the proper amount of investments to generate 6 to 12 months worth of income. That's the normal recommended amount to have sitting in cash. That way, if the stock markets are very volatile, you don't have to worry about accessing anything other than the cash. You may also want to sell out the percentage that you should have already adjusted for safety as a hedge against future losses. Now, the downside to this option is that you are indeed locking in losses. But the upside is that you are also avoiding additional losses if the stock market dives even deeper. Now, if you're scared of the latter, selling out even at a loss may be your appropriate option. In 2008, a lot of investors held on and waited, and they finally sold out when they just couldn't take the fear anymore. But unfortunately for a lot of them, that was after the stock markets had already fallen 40, 50, 60%, and they had lost half of their money. That's right. A lot of investors sold out at or close to the bottom. It happens all the time. Then, because they waited so long to get out and they were now so fearful that the markets would never recover, a lot of investors actually couldn't bring themselves to put money back in when they were supposed to. And then they actually waited for years and missed the rise of the stock market after the big sell-off in 2008, 2009. This caused them to also miss out on a lot of the recovery. So if you're going to sell out, sooner rather than later is usually the better time to do it. And then you need to have a conversation with your financial advisor about how and why and when you would buy back in. Now, basically, if you have more than 3 years to go before you retire, this is probably not your best option. You probably don't need to go this far as selling out. But again, if you're already retired or just about to retire and you don't already have money moved to safety or sitting in some cash, this is a good conversation to have with your advisor. Option number 2 is phasing out. Now, if you've got a few years to go before retirement, are you just scared of what the stock markets are going to do for the near future? You might want to phase out of the markets. Instead of selling out all at once, a phase out method moves a certain percentage of your investments over to the sidelines in phases at certain intervals. Phasing out is a great method when stock markets are swinging both up and down, and you're not certain of which direction it's going to keep going, either up or down. The specific amount you move out and the intervals, the time frame for moving it will differ based on your goals, but one example is to move 25% of your investments out of the markets every week or every 2 weeks or every time the markets fall by a certain percentage, say 8% or 12% or 15%. By phasing out, you're limiting your losses to just the percentage that you moved out of the investments while still allowing the rest of your money to stay invested in case stock prices go back up. This also hedges a portion of your money from additional loss in case they keep going back down. And if they do, you will keep phasing out your money until all your money has been moved out or the markets have stopped falling. Now, it's true, you never know if the stock market is going to go down or up until after the fact. You and your advisor can set up a phase out method that's right for your situation. And then once the stock market stabilizes, you can just begin to phase your money back in the same style that you phased it out, putting it in every time the stock markets rise by a certain percentage or every certain amount of time that you decide is right for you. This is going to then allow you to take advantage of the gains while still limiting some of that exposure to your money in case things change and markets go the other way. The third option is to ride it out. So if you've got more than 3 years to go before retirement and you're comfortable with the idea that this situation we are in is temporary, then you probably just want to ride it out. You want to let whatever volatility is currently taking place run its course. Consider back to the 2007 to 2009, the Great Recession, where it erased 50% of stock market gains. At the time, it seemed like the crashing markets would never end. In fact, some days it almost felt like the world was coming to an end because of the financial markets. But in reality, the worst economic times that we've seen in decades only lasted 18 months before the recovery started, and then what a recovery it was. According to an article on MarketWatch.com, if an investor bought into the stock market the exact day before things started to decline in 2007, so you bought the worst possible day, and then you just left your investments alone, you didn't touch them, you just watched them go down and then come back up, it would have taken you about 4.5 years to fully recover. Now, yes, I know that's a long time to watch your money recover, but it did recover. And in the big picture, it not only recovered, it then went on to excel and make a heck of a lot more. And it's a relatively short time frame to gain back 50% of your money after a big loss. Had you kept investing as normal, kept putting money into your IRA, kept funding your 401k, your recovery would have actually happened much, much faster. So stock markets have always and will always go up and down. Being prepared to ride out the downtimes is an important part of being a successful investor. Knowing how much time you have before needing your money and sticking with your investment plan is the key to coming out the other side of a correction on top and even stronger than you were before. If you've got a game plan and a professional advisor that you're working with, just stick with it. And then there's the fourth option, buying in. Periods of increased volatility and big market declines should also trigger something else besides just fear if you're financially prepared and you've got years to go before needing to access your money. It should also trigger a sense of opportunity. Every big market crash is an opportunity to go in and buy more while stocks are on sale. Yes, there are risks, of course, to buying into a declining market. The expression, "don't try to catch a falling knife," comes to mind. You don't know how long things will go down. You don't know how far they will go down. You don't know how long it will take to recover. These are all important conversations to have with your advisor, but in the right situations, buying in during big sell-off periods could be a way to catapult your future wealth. After every depression, recession, or stock market crash, we've seen the same two things. First, a return to normal, and then eventually higher stock market prices. For years now, stock markets have been at an all-time high. We've had weeks where we've broken records and hit new highs every single day. That will happen again. We just don't know when. But what we do know is that from World War II all the way up to the current day, the stock market drops at least 10% every 16 to 17 months. We also know that it typically takes about 2 months to recover. Sometimes, like in recent days, a specific event sends stocks tumbling into much deeper dives of minus 20 to minus 40. And as discussed in a recent podcast, the News, Noise, and Coronavirus show from a couple weeks ago, this most recent event is so far more of a temporary topic than a long-term trend. We'll see if that continues, but that's where we are today. And for a short time, what it's done for those of us who are prepared, it's given you an opportunity to move extra money into the stock market while just about every stock and every market index is down. Let me ask you a question. If you could buy a brand new iPhone for 30% off, you'd probably be smiling about it and you'd probably make that purchase. Am I right? Well, from the recent market highs to the recent market lows, you could have bought stock in Apple and actually owned a little tiny slice of the company for about 30% off. But most people were scared instead of excited. How about you? While buying in and adding more money to your investment account may or may not be right for you, it's at least worth having the conversation with your financial advisor if you've got more than 3 years to go and you're comfortable that this is a short-term event. Now, let's be clear. You want to be careful about which funds you use to invest into the stock markets. For example, you might not want to take money out of your emergency reserves to be investing. But if you've got extra savings sitting around, this is a great time to maybe add more money into extra investments. You also need to know, when am I going to need to get that money back? What am I going to need to use it for? And you should have a strategy as to how you will invest that money. Should you do it all at once or put it in over time? And then you need to have a game plan as to what types of investments that you should buy into, individual stocks versus stock market indexes. Lastly, you need to have a game plan for taking your extra investment money back out. How will you capture those gains? How will you know when it's time to get back out? Yes, there's a lot to consider before going in and buying more, but there can be a lot to gain as well. As long as you're set up properly, and if it's the right thing for you to do, it's definitely something for you to explore. So what's best for you? Those are our 4 options. Should you sell out, phase out, ride it out, or buy in? What it really boils down to is which option is right for your specific situation. It might be right for you to combine a couple of options. Maybe you need to be riding out the market declines while adding in some extra funds over time. Maybe you should be phasing out of the markets with some of your money and riding it out with other portions. This is a great time to review your plan, to look at both your defensive position as well as new opportunities, and make sure that you're set up in the best possible way to achieve your long-term goals. Every big market decline eventually ends. Every big sell-off has always recovered. When it's over, some people will have been hurt by it, but others will have been prepared and profited from the exact same event. Now, if you have not reviewed your plan over the last 6 months, now is the time to do it. So contact us, give us a call at the office, or email us and let us know when is a good time to have a 30-minute no cost to you financial review to make sure that your investments are set up the right way and make sure that you're prepared to profit and not be hurt by the current situation. 685-8585, 719-685-8585. That's it for this week's show. If you've got questions about your own money puzzle, please email those to questions@yourmoneypuzzle.com. Share us with any friends, colleagues, coworkers who need to hear this message and who need to know that you will be okay if you're prepared, and what are the 4 best ways to handle a declining market. And last but not least, please go and rate the show if you have not done so already. Whatever podcast app you're listening to, or on YouTube if you're watching, give us a thumbs up, leave some comments. We'd love to hear from you. That's it for this week. Until next time, be safe, stay healthy, stay virus-free, and go out and do something to improve your own money puzzle. Your future self will thank you for it.
Registered representative of and securities offered through Securities Management and Research, Inc., SM&R. Member FINRA SIPC. Investment advisory services offered through BFC Planning, Inc. Edgen Insurance and Financial Services, Johnson Financial Services, SM&R, American National Family of Companies, and BFC Planning are independent entities. There are risks involved with investing which may include market fluctuation and possible loss of principal value. Particular investments may not be suitable for certain situations. Carefully consider the risks and possible consequences involved prior to making an investment decision. Our firm does not provide legal or tax advice. Be sure to consult with your own legal and tax advisors before taking any action that may have tax implications.